What you're looking at right now is the trajectory of the S&P 500 there in blue compared to that of McDonald's stock in gold. Whereas we could see that the S&P year to date has soared by over 10%, all while McDonald's stock has actually faltered by just under 9%. So today I wanted to go ahead and ask the big question for us all. Should we in fact still be loving it for the McDividends, or is it about time we just begin to look elsewhere for Big Mac's dividends, income, and total return? With that, are you ready? So as you just saw, McDonald's, when compared to the S&P 500, really hasn't been performing too well this year. Now, I wouldn't say that it's a fair apples to apples game comparing McDonald's to the S&P, so let's go ahead and look at McDonald's on its own. We could see that McDonald's really has just been in the red all year long, down by this point in time by 8.88%. And if we zoom in here just the last handful of days, we could see that the stock's been inching up. Heck, even over the course of the last month here, it's been climbing. But the big question is McDonald's still a safe bet for the long-term investor? Does it really have the power to not only rebound, but continue to climb to higher highs like it's been doing all the way back since its date of inception in 1940? Well, that's what we're about to get to the bottom of right now, right here, by discussing McDonald's business model that you need to understand, our macro environment that's directly impacting McDonald's and all of its competitors, before concluding with some stock talk for you to really mull this dividend stock opportunity over. Now, first and foremost, what you need to understand is that McDonald's, to the masses, is really seen as a fast food juggernaut. Best known for, of course, their Big Macs and salty fries, which, don't get me wrong, it's certainly developed quite a reputation for those Big Macs and salty fries. But there's more to this picture than actually just burgers. So low-key, McDonald's is a real estate powerhouse. That's the big takeaway. You see, even the former McDonald's CFO, Harry J. Sonneborn, is quoted saying, "We're not technically in the food business. We are in the real estate business. The only reason that we sell 15-cent hamburgers is because they are the greatest producer of revenue from which our tenants can pay us rent." Burgers aside, the reality is McDonald's amasses serious amounts of revenue by buying and selling hot properties while collecting on rent from all of their franchise locations. So with a global footprint here making up a presence in over 100 countries with over 36,000 locations and only actually operating and owning 15% of them, McDonald's corporate really gets off scot-free on expenses left and right, hands down, saving a ton of money and making a ton of it as well, thus making for a brilliant business strategy, insulating the company from all the ups and downs of the business of flipping burgers. Because even in a time like right now when consumers are pulling back, franchises still have to pay rent. Now back to the burgers. McDonald's sells close to 50 million burgers a day worldwide, which is no joke compared to, say, Burger King selling 15.7 million burgers a day, and then we have 1.44 million chicken sandwiches being sold over at Chick-fil-A. Now comparing that to all the competitors of McDonald's results, we're really just not seeing any real competition. So if that's the case, then what's the deal here? Why is the stock even sliding at all? I mean, business is always booming. It's got a heck of a moat, right? Well, yes, but also the stock share price, as I'm sure you know, is never indicative of how the business is actually operating. Therefore, I wanted to get into some financials and macros with you to really understand this picture. Now, when it comes to our macros, I've been harping on this video by video, so subscribe now to really get all the need-to-know economic insights on a week-to-week basis that are very likely also impacting your stocks. But McDonald's-wise, prolonged high inflation and higher interest rates didn't just deter consumers from actually spending with McDonald's while simultaneously eating away at the value of the consumer's dollar. Inflation also hit McDonald's very hard when it came to buying raw materials and wages for their employees. Now, in regards to consumer trends, well, sales of course fell below all consensus expectations due to negative traffic trends, leaving McDonald's questioning what exactly they should do to combat the economic turmoil that we've been living in. And their immediate chess move that they just made has really been tweaking their brand value and consumer perception by leaning more into menu value, like their most recent move here to reintroduce the $5 meal deal. Now, McDonald's also worked very diligently to improve their digital footprint, which actually did wonders for the company, with sales in their top 6 markets closing out about 40% of the total sales. And that's not it. McDonald's actually, despite the consumer shifts changing, remains steadfast on their real estate empire over their burgers, with new restaurants signaling market confidence. As for me, my honest thoughts on the macros, Well, I'm going to stick to it in sharing that we're likely going to remain in this environment of higher inflation and higher interest rates for a prolonged period of time. But we're not going to be in this environment forever. The Federal Reserve will eventually need to lower rates, which should definitely help McDonald's on all fronts, both on their real estate side and their burger sales side. Now, also signaling confidence here is their share buyback program, to which we just saw about $921 million spent buying shares back this past March. And while there have been some recent insider trades with insiders like the executive vice president selling shares just days ago to others months ago, it's the hedge fund activity that actually gets me, because they've been buying with over 272,000 shares already purchased last quarter by smart money. And in addition to smart money, we do have analysts that are coming in with hot forecasts at $306.17. That's making for about 13% worth of upside from today's levels. Now, as for me, I'm personally still loving it and will remain a fan of McDonald's stock in the near term and for the long haul, as I see the business running very smoothly even while we reside in the muck of these troubling economic times. And not only that, I wanted to go ahead and just have you understand that I don't see McDonald's burgers disappearing anytime soon, as consumers simply seek affordability and dining out experiences. McDonald's is always going to be there, I think, for consumers regardless of their income level. You're going to have a great time at McDonald's. After all, we could go ahead and look at the COVID lows that actually McDonald's rebounded from, experiencing over 24% worth of growth over the last 3 years, 52% worth of growth over the last 5 years, and a whopping 244% worth of appreciation over the last decade, with plenty of ups and downs during that time. Now, I am, as you know, a dividend investor. So of course we have a nice McDividend coming in here to enjoy with McDonald's, with a dividend yield at 2.47%, which has remained intact for the last 47 years without interruptions on that growth track, averaging about 15% worth of dividend growth year over year, at least for the last 20 years. But now, investors, I just have to know, are you still loving McDonald's? Is it in your portfolio? Are you buying more shares, avoiding it like the plague, selling it? Let me know your thoughts down in the comment below. Be sure you're subscribed for insights every single week, or you can actually just click right here for more insights now.